Good evening, all the joinees. Thank you for joining in. This is Prajakta. I would like to warmly welcome you all on behalf of NGEN Research. So, meanwhile, others join, let us introduce the topic that we are going to discuss in this week's webinar. So, today we are going to discuss on the optimization facility for portfolios that we have on NGEN Markets. Our discussion will predominantly focus on understanding the improve function, which is predominantly there on portfolio analytics on NGEN Markets. Next, we will understand the difference between the ranking models and the value models that are there in these two, in this the entire improve function, which is typically used to optimize the portfolio allocations. We will see the three sub-modules, or for that matter, sub-models that it has. So ranking has three sub-models: ranking returns, minimizing volatility, and third, ranking sharp. So we are going to see all of these. Next, we will understand how do you save optimized portfolios onto NGEN Markets, and then run a side-by-side comparison of two portfolios simultaneously, and then generate actionable proposals out of the same. Finally, we will throw the forum open for a Q&A session wherein you can get your questions answered by directly typing in the chat box or directly unmuting yourself to speak. So let us now begin. So for this week's webinar discussion, we are going to focus on the portfolio analytics section directly. So what I've really done is I've opened portfolio analytics. I've taken one sample portfolio that's called a test portfolio. It's a portfolio of 6 mutual funds. The components you can see right here. So Axis Focus 25, Quant Small Cap, Parak Parik, Flexi, iPro Blue Chip, Sundaram Liquid, and HDFC Balanced Advantage. So these are the 5 funds that I've taken. I've purposely taken that as an equally allocated portfolio. So every fund in the portfolio is an equally allocated one. So there's no bias as to one fund given higher allocations or such, right? Typically, this is the process that you would be, following for when you're generating or rather shortlisting funds to be given in your model portfolios. So let's say, let's assume that this is a case when these are the 5-6 funds that you've shortlisted, and then you're going to give these portfolio to your clients, right? You're going to service your clients by recommending this portfolio to them, right? Now, not all clients will have similar risk appetites, right? Not all clients will be, at same risk-taking capacity, right? Therefore, some might be inclined towards minimizing the volatility, but going ahead with a fair mix of debt and equity funds in the portfolio. On the other hand, some others could be slightly on an aggressive side, or rather, majorly on aggressive side, and that they would typically chase returns irrespective of the fact whether the volatility or the risk that is attached to the portfolio increases manifold, right? So it could be diverse set of clients. But then when you're deciding on the direction on the basis of the allocation that you should be giving to each and every fund that you have had in your portfolio, there should be some starting point, because it cannot be extremely random. You have to have one starting point so that your direction, your path is clear. Okay, this is what I should be following on to at least come up with a decent portfolio allocation. This is where improve function that we have on NGEN Markets comes to your assistance. So this, as we say, is a first step that will be your, it will guide you to take that optimal allocation decision. Of course, this is not the final one, because customizations to this allocation that will be suggested by the models is absolutely possible and is required also, right? But this could be a very good starting step. So what you will do is you'll click on run analytics, and the first option that you see beside the name of the portfolio is called improve, right? First, before going to improve, let's first note that we've changed the start date of this portfolio analytics to a 5-year period. Therefore, the entire analysis on this portfolio of 6 items is happening from 14th of May 2019 to 16th of May 2024. So for all the components, whenever I'll put values in an Excel sheet to calculate the returns out of these portfolios, it is going to be a 5-year return always, because we have to maintain that parallels. Okay, now let's click on the improve function, and let's understand first what does it really try to say. The moment I click on improve, you will see that a small window opens up, which says that, okay, these are the 3 pie charts. Basically, these are the 3 graphical manner representations that you can see. First one is color coded into blue, and it says annual return. Next is a bar graph indicating volatility, And the third, the sub-model number 3, that's sharp, is indicated by this line chart over here. So this is the meaning or interpretation of the graphical manner representations that you see at the top, right? Now it is going to give you 6 models, right? So one is ranking model. That's category one is ranking models. Option number one is ranking models. Option number two is value models. Each of it has 3 subcategories into it. So ranking returns, ranking minimum volatility, ranking Sharpe ratio. Value also has the same returns value, minimum volatility on the basis of value, and Sharpe ratio on the basis of value. So everything is going to have 3 each. So 3 plus 3, that's 6. Plus original allocation, which is equally allocated portfolio, which is the original allocation. And that's why this is called original. And the last is the equal weights. Now, in this case, because we have originally chosen an equally weighted portfolio, this and this is typically redundant in our case. Right? This is just a duplication of the same thing. You will see the exact same values here, in this case at least, right? So first of all, let's understand, now that we've understood the graphs, let's understand what we're trying to do here. When we click on improve, we're not trying to add any new funds in the portfolio, right? Neither are we trying to remove funds that are already there in the portfolio, and suggest any new funds. That's not something that is our objective at all here, right? We're going to play around with the exact same funds. The only thing that we are going to modify is the weights or the allocations that is given to every fund that is there in the portfolio. So now focus here, solution weights. So solution, this is like a question. This is like a question that we are running, and this is a solution that the model is giving. This is a mathematical solution. Okay. The first is, of course, original. With the original weights, it's an equally weighted portfolio. Second, now this part, 8.16%, 40.82%, all of this, please don't be confused. These are portfolio weights that are given in each of these models that we are going to understand in detail, right? So this, mind you, is not returns. This is, mind you, is not volatility. This is simply allocation. That means, if I go ahead with ranking returns, it tells me that quant small cap fund, instead of your original allocation of 16% in your portfolio, now gets a 40% in the portfolio. So out of 100%, if let's say 1 lakh rupees is invested, 40,000 will go to quant small cap fund. That is exactly what this 40% in rank returns means. Okay, similarly, it will work for every other model that you can, every other column that you can see right here. Okay, so once we are through with this, so this part should not cause any more confusion. These are simply allocations. Okay. Next, you'll see some return numbers here. So one is annual return. Of course, that is coming in directly from, because we are catering to 3 models. One is returns, second is volatility, and third is Sharpe. Now, every single time, every single model runs, these numbers are going to change, right? So original portfolio annual return, portfolio level annual return with an equally weighted portfolio was a 20%, right? On the other hand, this annual return increases to a 27%. And that, mind you, is the highest that can ever be achieved in the last 5 years time period that we are analyzing with these portfolio allocation, with these funds in the portfolio. So if these are the 5 funds that are there in the portfolio, 27.44% is the maximum return that can ever be possible with these 5 funds, right? And to achieve that 27% return, what should be the allocations is what ranking returns model is going to tell you. Okay, so that annual return has increased 7%. In order to increase the annual return by a 7%, what has really changed, right? The allocations have changed, but when the allocations change, the risk that is attached to the original portfolio is also going to change, right? Because as the allocation changes from an equally allocated portfolio to a higher allocation to a fund which generates very high returns, for example, in this case, quant small cap, it is definitely going to come up with a higher volatility number will be attached. And that's why the portfolio volatility, as you can see, has increased from a 13% to 15%. Right? So 2% jump in the volatility, which is of course a measure of risk that is attached to any particular portfolio. The next measure that you can see is the Sharpe ratio, right? So Sharpe ratio is a measure of risk adjusted returns. In other words, it says, okay, for per unit of risk that you take, what is the return that your portfolio generates? Now, it's a no-brainer. that with a per unit of risk, you would like to maximize, or any particular person, sane person would like to maximize his return, right? So therefore, we say higher the Sharpe ratio, the more desirable it is, right? That's why is that so? Because it maximizes the return that is generated per unit of risk that an individual takes, right? In this case, as you can see, it's also maximizing the Sharpe ratio that has increased from a 1.01 to 1.33, right? This was a basic understanding of these three columns, or rather these three rows that you can see. After that, of course, these are the save buttons wherein you can save these allocations. Of course, we'll come to that in a bit. Now, let's understand the logic with which we are, rather, we have categorized, or rather differentiated the ranking models from the value models. So I'm now going to do some number crunching on the Excel sheet. Please bear with me. I'm going to write it down, write everything, all the names of the funds in one single Excel sheet. And then we are going to actually derive at these weights, considering the actual annual returns of each of these funds individually, and after that, arriving at the portfolio, right? So for that, I'm going to directly switch on to an Excel sheet. I hope my Excel sheet is visible. So in this case, we have 6 funds. So I've taken 3. Let's add the balance funds. So we have Access Focused, Quant Small Cap, Parak Parak Flexi Cap, iPro Blue Chip, Sundaram Liquid. So iPro Blue Chip, Sundaram Liquid, and the last one is HDFC Balanced Advantage. These are the 6 funds that we have. Now we are first going to focus on the value model, right? This is the value model. This is what I'm going to explain you first, because this is extremely straightforward, very, very simple to understand. Okay, but first, in order to even arrive at this value model allocations, we'll have to find out the actual underlying returns of individual funds. So for that, I'm just simply going to close this for a minute, and then I'm going to click on every single fund, and I'm going to note down the 5-year annualized return that is generated by each of these funds, right? Because in this case, we are trying to arrive at the allocations which are given by the value model, right? So I'm going to click on Access Focus 25 Fund. It gets open in a new tab. Let's remember the drill. This is going to be exactly the same for all the other funds that we are going to do. The first thing that we do is we change the start date to a 5-year period, right? Everywhere, every fund that we are going to do, we are going to do the exact same thing. So we have taken a 5-year start date, 14th of May onwards, and a 5-year annualized return for the particular fund is at 12.94%. We take this and put it into an Excel sheet. So of course, this is annualized returns of individual funds, of course, right? Access comes to a 12.94%. Next is Quant Small Cap. We are simply going to replicate the same exercise. I click on it, I change in the start date, and I note down the annual return of that particular fund. So it's a 40.76%. 40.76%. Next is Parak Parik Flexi Cap. Again, drill remains the same. You change in the start price, start date. 23.96 is what I'm going to note down. Next is my iPro Blue Chip. This exercise, mind you, we are doing to understand the logic that goes, underlying the calculations that, are involved in calculating the ranking models and the value models. That's the reason we are doing this. Once this logic is clear, you can then, need not repeat this exercise every single time. This is just for initial understanding. So it's a 18.94%. Sundaram Liquid and HDFC. It's a 5.01% for Sundaram Liquid, and makes sense also. It's a liquid fund. and HDFC balanced advantage. It's 19.55%. Once we have all of these actual return numbers, annualized return numbers for each of these funds, the second thing that we'll do is the weightages that are actually originally given to each of these funds, right? So actual weightages, of course, original weightages were, of course, equal weights. So with equal weights, what are the portfolio returns? So it's a 16.67, I think, to every fund. What we then do is simply a sum product. So that's a multiplication of this, and then a product. So I simply use an Excel formula for this. I want to multiply this by the second column, that's column C. And then I hit enter. Look at that. So the return of my portfolio, right, is a 20.19% given equal weights, and that is exactly going to match with this one, right? Look at that. Of course, differences after the decimal will typically happen because ultimately maths and there are some rounding off errors that will keep on happening. So ultimately, this is how we've arrived at this equally allocated portfolio, which happens to be the return of a portfolio when it's an equally allocated portfolio. Now, we are going to arrive at the values, right? When the allocations change. The moment we click on improve now, these are the allocations that we are targeting, right? So let's understand how typically this changes. So if these are the values that are given, these are the allocations, then that's the return that will be arrived at on a portfolio level. So to arrive at a 25% return on a portfolio level, these are the allocations that should be given. And that is what is said by the model. Now we are trying to replicate this. So first of all, what we'll be doing is we will take the logic that goes beside or the behind this value models is it takes into consideration the actual values, return values of these funds and multiplies that by these weightages, right? So actual return numbers we anyways have. What we are going to do is we are simply going to multiply these by the weightages that have been suggested here, right? So these are the returns. These are the weights that have been suggested. So I'll try Control C 1 second. Yeah, these are the weights, and I'm simply going to copy this. Look at that, 1% differential, but I mean that's something that's acceptable. So you simply change it to one article format. Yeah. So this is the return that is achieved if the weights are changed accordingly, right? 1 second. Oh, just a minute. Yeah, right. So 25.54. This is the percentage that we have arrived right here, right? Sorry, I got confused with a little bit of a formula in Excel. So that is what it is. So if these are the allocations, this is the return portfolio return that gets generated, which is 25.54%, which is the jump by a 5.54% than the original allocations, right? So that is how we've derived at the value models. So that just justifies the fact that to arrive at these allocations, or for that matter, to arrive at this return number, right, it takes into consideration the actual returns of each of these funds that are under consideration. Now, how do we arrive at the ranking returns? Just ignore for the time being these two columns exist. So volatility and Sharpe ratio, just ignore for a minute, right? We're now going to derive at the allocations that are appearing in the ranking returns model, wherein we'll be understanding the actual underlying fundamental difference between value models and ranking models. So now ranking models is the number one step that it will involve is it will give ranks on the basis of the returns, underlying returns of each of these funds. So for that, we have anyway added that in an Excel sheet. So simply let's add a column here. Oh, sorry, yeah. So now let's rank each of these funds on the basis of their individual returns. Of course, rank number one um, goes to quant small cap because it has the highest return, right? Rank number two will go to Parag Parikh Flexi Cap because it has the second highest or the second best return. So 23% is rank number two. Rank number three will go to a HDFC Balanced Advantage Fund because it has the next best return, right? So that's the rank number three that will be given. Rank number four will be given to a iPro Blue Chip that has the next best return, right? 1, 2, 3, 4 done, 5 and 6. So fifth rank goes to a Axis Focus 25. It has a 12% return, which is definitely better than the least, which is Sundaram Liquid Fund, which gets rank number 6. Now, this is the base that ranking models use. So these are what we've given ranks because it's done manually. But when it's a 15 fund portfolio, we could use a simple formula to do that. Right? I've purposely given it manually so that we understand what is really happening here. So rank number one, highest return, next best, and then sixth rank is the worst. Basically, this is like students getting percentages. So 5% is very bad performance. Therefore, it gets rank number 6. Now, once ranks have been arrived, how will you allocate a portfolio allocation? Portfolio is 100% allocation. You want to give allocation to these funds on the basis of the ranks that they have secured. So for this, we do a simple maths wherein we are just simply going to divide each fund by its rank, 1 divided by the rank that it has scored to actually arrive at the value. So plain simple no-brainer. If my portfolio were to consider or rather were to comprise of only one fund, then I would have given entire allocation, 100% allocation to which fund among these? Simple no-brainer. I would have given the entire allocation. Of course, please ignore the fact the volatility will increase, Sharpe ratio. Just ignore all of this because we are currently focusing only on returns, right? If my focus was only on returns and I were to give entire allocation in my portfolio to only one single fund, I would have given my entire allocation to quant small cap because it has ranked first in the entire list of 6 funds that I'm analyzing, right? So therefore, when I do 1 divided by the rank that quant small cap has, one second. When I do a 1 divided by rank that quant small cap has, it gets an allocation of 1, right? Entire 100% allocation. But now my portfolio is not a one fund portfolio. My portfolio is a multiple. It's a 6 fund portfolio. Therefore, I have to arrive, or rather, I have to give allocations to every single fund, right? I cannot, as we said, right? Improve function does not exclude funds that are already there. It has to give consideration to every fund in the portfolio. Therefore, I'll replicate this process for all the components that I have. What I'll simply do is I will say, okay, is equal to 1 divided by the individual funds rank. So in this case, rank number 2 is for Parag Parikh. What it is trying to do, so if my portfolio was comprising 2 funds, then 50% would have been given to Parag Parikh, 50% to quant, right? Therefore, it is saying that if my portfolio was 2 funds, 50% allocation would have gone to Parag Parikh Flexi Cap, right? Because it's rank number 2 fund. Similarly, for all the other components, right? So this is how in a descending order it will be. So 100% weightage to quant, 50% weightage to Parag Parikh, next weightage to iPro, after that HDFC, and then Sundaram. Right, one second. Okay, now this totals, right? My portfolio at any point of time cannot be more than 100% allocated. right? So you have to in some way derive at allocations in such a manner that it adds up to 100, right? How will you ensure that? For that, you'll have to take a sum of all of this. So this 2.45 is the total that I have, but there's a capital restriction. My portfolio at any point of time cannot be 100, more than 100% allocated, right? So we have to now arrive at such a allocation, which out of 100, it will give XYZ percentage to a particular fund in such a manner that my ranks, return ranks that I've given are taken into consideration. Now, what will you do? So that means my entire universe is 2.45. Out of 2.45, 1 out of 2.45 goes to quant small cap. It's plain simple mathematics. You say is equal to, you say 1, say divide it by 2.45 and hit enter. So 40% of my portfolio will go to quant small cap. Basically, what we have done is we have rescaled everything, or rather restated everything to 100%. Portfolio cannot be more than 100% allocated, right? That is exactly what we have done here. Now, 40% went to quant. Now, what will happen for the rest? So we'll do a simple math right there as well. So I say function F4, I freeze this, enter. Okay. So if these are my allocations and my portfolio has to be 100% allocated, these should be my allocations, right? So let me convert all of this to percentage. It'll be a little easier to understand. Right? If my portfolio is 100% allocated, 40% of weightage in my portfolio has to be given to a quant small cap fund. Only then will I attain my objective of maximizing the annualized returns of the portfolio. The least weightage, as you can see on Excel, we have calculated. Please keep in mind, we've not even referred NGEN Markets, right? I've derived these allocations and we will cross-verify with NGEN whether this calculations, the entire number crunching that we do, does this actually hold up with the NGEN model, right? The last allocation, or the least allocation has to be given to a Sundaram liquid fund, and which is in fact a no-brainer because it being a liquid fund, its return would be the least among the entire lot. Therefore, it has been given the least amount of weightage. Now, let's cross-verify these numbers with NGEN Markets. For that, again, we're going to go back on the platform and look at these. The ranking models, ranking returns, focus on the ranking returns. 40.82% has been given to a quant small cap fund, right? Which is exactly matching with what we have derived. Right? This is the math that goes behind or beneath arriving at the allocations that we have, really shown here in the optimizer. Right? So there's no, objectivity that's involved, subjectivity that's involved. It's extremely objective values and formulas and the algorithm that goes behind, and that's how we arrive at the ranking models. Now, it's an interesting fact that we should note that if you load any other portfolio which has a set of 6 funds, right? We'll load in another portfolio now. And the only thing that we are going to keep in mind is the number of components that it has is 6. Now, why is that so? That's because we'll see a magic. That's because we are just going to go and click on cancel. Let me just take in some random 6 funds in the portfolio. 1 second. All of this. That's not edit. Okay, this is a 6 fund portfolio. For the time being, I'm going to equally allocate it. Doesn't matter though. I'm going to click on update. Now these are completely new funds. Okay, I've not repeated any of the fund, right? I click on run. Please note, the only thing that I've kept constant is a 6 fund. Number of funds in a portfolio are kept constant. Again, I'm going to say 5 years. And I'm going to click on improve. The magic comes here. The moment you click on improve, because it's a ranking model, look at the allocations. In the ranking model, of course, this will not hold up for value. Look at that. This is a completely new portfolio, which has just 6 mutual funds, which are totally different than what we had. But in spite of that, the ranking returns model will give the highest allocation of a 40.82% to that particular fund, which has the highest return. and this percentage does not change. Why? That's because it has arrived at ranks. It has given ranks to each of these funds that we have in the universe. Rank number 1 goes to quant small cap. Rank number 2 will go to iPro thematic advantage. Rank number 3 will go to Kotak flexi cap, and so on. Therefore, what happens underlying, what are the actual underlying returns of these funds are not a consideration in ranking models. That's why we call that as a concentrated approach. It is a very cutthroat approach. It will say that, okay, Kotak, flexi cap has gotten rank number 1. I don't really care what is the rank number two's actual returns. As in this case, right? A difference between HDFC balanced advantage, its actual return is a 19% versus iPro. The return difference between return is only 1%. But look at the difference in allocation, right? HDFC balanced advantage gets a 13% allocation versus iPro gets a 10% allocation. Why? Because it has rank number 3. Rank number 3 plays a rank number 4. It will not give any regard to the underlying values of the returns once the ranks are arrived. So the job of these annualized returns stay only until the ranks are assigned. Once ranks are assigned, it is only going to consider these ranks to arrive at these allocations. Therefore, we consider this as a very concentrated approach. You would have heard this in a lot of trainings. Our training team tells you that, okay, this is a concentrated approach. That's because it will consider, okay, rank number 1 given to a particular fund, it'll maximum allocation of the portfolio will go to that particular fund, right? On the contrary, what value models will do is it will actually take into consideration the underlying return values, right? Now, the moment I will change this value, this particular thing, the sum product is going to change, right? The moment I do a small tweak here, right? This changes to 10%, this is going to change, right? That's why they are called value models, because it will give consideration, a lot of consideration to the underlying value numbers of each of these funds. Therefore, we will not be able to see that, quote unquote magic that we were talking about when we compare value models with a ranking model. Value models, every single time, it will depend upon the underlying funds values, return values, and therefore the allocations will never match, right? It's ultimately plain simple mathematics, right? So this is what differentiates ranking models from value models. Ultimately, value models follows, you will see that, a balanced approach, right? Because in this case also, it has given the highest allocation to Kotak small cap, which was in fact the case, right? Highest allocation has to be given to that. But a considerably, a decent allocation is also given to the second best fund, right? That's 24%. Third best fund, 20%. It will try to, not keep all of your eggs in one single basket, right? Therefore, we call this as a balanced approach. Similarly, all of this can be replicated for volatility and Sharpe. I'm not going to, repeat the entire calculations, but the logic is what is going to stay the same. Of course, in this case, if you're going to focus on the volatility model, it will try to give the highest allocation to that particular fund, which has the lowest volatility, right? Because that is what is the case. The name of the model is minimizing the volatility. Oh, by the way, wherever you see it's volatility and not volume, right? Please don't be confused. This is minimizing volatility, right? Therefore, the highest allocation has to be given to that particular fund which has the lowest volatility, right? And accordingly, the others. Of course, in this case, the least allocation will be given to that particular fund which has the highest volatility, which in this case happens to be a Kotak small cap fund, right? Look at that, least allocation. Sorry, Kotak flexi cap in this case, right? So this is the major difference between ranking and value models. I hope this is extremely clear. Now, moving on to the last part of the webinar, wherein we'll be discussing as to once you've saved, once you've created these optimized portfolios, and then you want to typically compare it side by side, right? Typically saying, or rather telling the client that, look, these were the schemes that I had shortlisted for you. If you would have, allocated it equally, this would have been your return, versus why should you give a 40% allocation to quant small cap, right? Or rather, any other fund that we are really analyzing. What is the logic for that? So that is the reason that we'll be highlighting right now. So I simply click on run. Now I'm going to save one of the allocations. For use case scenario, I'm going to highlight and save we are going to compare an equally allocated portfolio with a ranked returns portfolio, of course, taking into consideration 5 years as a time period. So our analysis starts from 5 years. So this is one thing that you have to ensure that you're keeping in mind. Everything has the dates have to match. Otherwise, data will fall off. You click on improve. 14th May 2019. This is the original portfolio that's called a test 102. And now I'm going to compare it side by side with my ranked returns portfolio, which gives the highest allocation to quant small cap. I'm going to simply click on save. The moment you click on save, this will ask you, what do you want to save this as? So this is going to save by default as test portfolio 102 dash optimized. But then of course you can customize this. I'm going to call this, okay, test portfolio 102 optimized for maximum returns. And then I'll click on create. The moment I click on create, a portfolio is going to get saved in my portfolios list. But you need to be a little careful because we've improved that portfolio. You'll be able to see it not in the active folder, but from improve folder. Of course, you can change the position where it gets displayed, but this is where it will get displayed, right? From improve by default, 17th May, 4:40 p.m. Right? This is the optimized portfolio that we've just created. Now, what we're going to do is we're comparing to these two portfolios side by side. So for that, I'll go to compare two portfolios. On the right hand side, always load in the optimized or the proposed portfolio that you want to highlight the client. So the name of that was test 102 optimized maximum return versus I'm going to compare it for the time being with my test portfolio, which was equally allocated. Test 102 equal. Yeah. So this is the portfolio that we are comparing. Of course, we will have to ensure that we put in a common start point, the one that we had run the entire optimization for, right? So I think it was 14th of May 2019, and I click on run. Look at that. This was the difference that we were actually seeing. The optimized model was showing us 20.27% for the original portfolio versus the optimized portfolio was at 27.45%. And that's an annual return differential of 7.18% for the last 7 years. Oh, sorry, for the last 5 years. Right? This is how you can highlight two portfolios side by side. Of course, there's not a lot of difference that you will see in the exposure part because ultimately, of course, the percentage would be different, but the underlyings are going to be same in different percentages just, right? So this is the difference that you can highlight. Once this is done, you can then highlight the rolling returns analysis, considering the same portfolio allocation, considering the same components, different allocations. The rolling returns, of course, changes. The lowest, of course, it was lesser in case it was an equally allocated portfolio versus when the portfolio is optimized for maximum return. The lowest definitely goes further worse, right? The lowest return for a 1 year holding period, or for that matter, 1 year rolling period, is a negative 18%. On the other hand, the average rolling return increases to 28% from a original allocation of a 20 original equal allocation, 20% average rolling returns. Right? As you can see again, rolling volatility has increased from a 15.91% to a 21.22%. Also, please note here, this is not the plain simple vanilla standard deviation we are talking about. This is rolling returns volatility. Therefore, this is double standard deviation. If you're looking at standard deviation, which is a plain simple standard deviation, which is a measure of risk, then that is available right here in the performance tab, which tells you, okay, this is the annual volatility difference. That's a 2% increase volatility, right? Because of course we have customized the portfolio allocations in that manner. Then you can highlight drawdowns, which tell you that, okay, how quickly does a portfolio bounce back from a loss that it has been experiencing. It becomes a good talking point. Once all of this analysis is done, you can then click on create PDF, and a nice presentable, actionable proposal will get generated, which you can then put forth in front of your client. This is something that can be done. So side by side, as we compared one original portfolio, one optimized portfolio, you could in fact load in a stocks portfolio that your prospective client might have, and you can compare that with a mutual fund portfolio also. So the options and the permutation combinations are limitless, right? You can simply play around with this. This is the functionality that NGEN has, wherein we can compare two portfolios side by side, right? So I hope this webinar was useful. this is where we approach towards the end of the webinar, topic related discussion at least. If you have any questions, please go ahead and ask them. The forum will now be open for a Q&A. Thank you.
Hello, am I audible?
Yes, please go ahead.
Yeah, I wanted to ask, see, the way you have improvised this portfolio, if we run the same portfolio after 6 months, it will show some other allocation. It may give parak a higher weightage, and
Mhm.
it can give quant a lower weightage. Then how will it benefit an investor in in putting this allocation in his portfolio, changing the portfolio as per the desired allocation where return are higher? So this is
Sh-
keep on changing.
Of course it will, right? As new information keeps coming in, the portfolio that it finds when it tries to optimize, it will change depending on performance. So depending on performance or volatility or whatever particular model you're following. Obviously it's impossible to come up with a portfolio that will work at all times, which doesn't require any changes. So what this helps you do is look at the current situation, and as of today, what is the best portfolio that you can create as of market conditions today. Obviously the future is impossible to predict. So what this does is gives you an approach where you can target, you can create a portfolio that target specific things like a low volatility or a high focus on Sharpe ratio or a high focus on returns only. And of course, if you follow a systematic method, that is generally speaking, um, should give you consistent results if you follow a similar process over time, where every month or every quarter you come and check how the allocations have changed and you follow those allocations. It can give you a much more consistent return series. Versus doing things ad hoc. But the whole point of this section is to give you a portfolio that looks good as of today's markets.
Okay, okay. Thank
Yeah,
you.
sure. Any questions? Please let us know.
So, Arunabh, in another words, you mean to say that whatever the portfolio, equal weighted portfolio or the other one which we are trying to recommend to the customer, if we
Mm-hmm.
check it again here 3 months after or 6 months after,
Mm-hmm.
ranking would slightly change depending upon the data, the performance levels and the volatility levels that time.
Of course, sir, it will definitely change. I mean, it won't
Automatically,
not change
it
that
will
much.
capture.
Yeah,
Automatically capture.
absolutely, sir. Of course, it will not change drastically because we are looking at not just short term but long term also. So it will not be a complete flip where you're, changing one. The top fund is becoming the bottom fund, but there will be subtle differences based on how the volatility is, how the returns are. And generally speaking, so with systematic investment processes or slightly, I wouldn't say algorithmic, but systematic processes, the small changes in your portfolio made month after month or quarter after quarter over time add up to a much more smoother return series because you're making the small adjustments required to stay in line basically. Um, and so the idea with this sort of approach is that every month or every few months, depending on how comfortable you are changing positions, um, you basically slightly adjust your portfolios. Now, what we are not taking into account here is whether or not it costs you to change your position. Theoretically speaking, it should change it every day, right?
Great,
But
agree.
but obviously that is an expensive and impractical thing to do. So in stocks or currencies, for example, generally speaking, we have some we've run models in the past where we change every other day, or if there's a change that is big enough, then we
Right.
actually go ahead and do it. With mutual funds, maybe the process of updating your models obviously should be less frequent. So even monthly is probably too much, but mostly quarterly is what people follow.
Correct.
So this approach, but one thing is there is that if you've decided that you want a portfolio to display lower risk, then
Mm,
over time you should keep sticking to the volatility models.
right.
But if you switch from volatility models to ranking models, then that's a call you're making, because then you're saying I'm going from a low risk approach to a high risk approach because I feel the market is going up. So
Right.
then you may get it right or you may not, but then that becomes your call. But in this case, when we built this model, we tried back testing the strategy itself, and the results were quite consistent with what it was trying to do. Where basically we went back in time and
Yeah.
recalculated the recommendations that come out of this process, and then checked what the performance would have been, and the low volatility and the high risk models were performing as
Right.
expected.
So in other words, this can be used as checking the portfolios of my customers every quarter or every month, whether there is any change or shift or
Absolutely, absolutely. That, in fact, that is the reason we created this, sir.
okay, okay. No, no, agreed. See,
Yeah,
what happens is, you have created it, but the perception or the understanding of us in a common layman
yeah,
term is little different. Ranking
yes.
model. Now, in a pure technical jargon, you may
Hmm.
understand with the purpose and the algorithm and the technical thing running behind.
Yes, sir. Yes,
But
sir.
for us, only when now Prajakta or whomsoever has explained
Yes,
ranking
sir.
versus value. So
Yes.
I used to take a balanced approach, looking
Mm-hmm.
looking at volatility on the lower side and the sharp
Yes.
higher side and the value on the higher side. So I never knew
Yes.
that this was ranking, this was value. I always looked at how to balance and where to see which one is giving higher return and which one is non-volatile.
Of
So
course,
now I've
I
got little
understand.
much
Yeah.
clarity with
Yes. Yes, sir.
so
Absolutely.
yeah, so every
Yeah.
quarter, we
Yeah.
the customers the portfolio.
Yeah, understand. So yeah, exactly. So here, I mean, the most balanced approach would be, the sharp on the value model, right?
Okay. Okay.
And the most aggressive would be the rank returns on the ranking model, right?
Right. Right.
Um, because that's purely like I'm just going to chase wherever the returns are coming, and the other one is, taking a much more balanced approach. So the decision of which model to use is obviously yours. So what
Right.
we're doing is giving you as much flexibility as possible.
Correct.
Yeah, yeah.
No, no, thank you.
No problem, sir.
No, it was basically trying to understand in the way, we could put it across to customer or we ourselves can update.
Exactly. Yeah.
Yeah.
Uh, Abhi, just now you mentioned that you have backtested this model.
Hmm.
If you can share those data with us, it will be helpful in understanding that, how it had helped in generating higher alpha.
Sure, sure. These results are not really available for us in kind of a sharing form, but we'll try to make them available. Generally speaking, what effectively, because again, when we backtest them, you can see that this model is in some ways constrained, because what it's doing is it's testing on a single set of funds, right? And that as soon as you change those set of funds, because it's not recommending new funds, and it's also not telling you to take away any fund and replace it, right? Over a long period of time, at least to test this sort of model, we have to stick with a set of funds only, right? And then see how a reasonably diverse set of funds only, and see how it performs. And then we tried this exercise with various different sets of funds, to see what kind of approach works best. But we'll see if we're able to put it together, because obviously, as you can imagine, that it becomes a lot of data, because there's historical weights every month.
Yeah,
So we'll see if we do.
any one or two assessment if you done in any specific portfolio would be great.
Sure. Okay. We will look into it.
All right.
Okay.
Arunabh, is it possible that you bring up a particular tab or a insertion whereby any rebalancing or switching or reswitching happening would take into account the tax efficiency part and the capital gain part or whatever, and tell us that we this would be costlier affair to change or this will be a better affair to change.
Right. Yeah. So far, sir, we have not considered the implications for tax at all.
Okay.
So to be very honest,
I
we've
agree. This is
only
a
looked
research
at
platform.
yeah.
Research
Yeah,
platform.
yeah. Yes, sir. But I mean, of course, we'll try to look into it, and I mean, and try to include kind of tax within the strategy, which would it would take some time to kind of do that, also some understanding also. But so far, all the work we've been doing has been independent of any tax implications, sir.
Agreed. No, in terms of utilizing your platform, we
Yes,
would
sir.
see now. I found out this particular thing
Yes,
to
sir.
check the portfolio every 3 months or 6 months of any deviation.
Yes,
The
sir.
same way, when we find a deviation and we want to help the customer with better returns and make changes, then we need to know the implications, which would be always the first thing in
Yes.
mind of customer.
Yes. I understand, sir. Understand. I mean, here we have kind of tried to systematize this process even further with the introduction of the Engine Fund Score,
Right.
because that, in essence, also takes some of these methods into account. So the score is made out of not just returns but also risk. So what happens is, uh, technically, like, if you follow a standard process, let's say you already know which categories you want to invest in, just simply selecting those categories in the screener and then picking up the top funds that are showing up
Right.
based on the Engine Fund Score can give you a very nice set of funds, and that's an exercise that can be repeated every 3 months. So
I do that. I do that.
yeah,
I do that.
yeah,
I
yeah,
do that. But I was not aware till recently when I took training that
yeah.
all the three scores are independent of each.
Yes. Yeah, oh, the you mean the models, right?
No,
The you mean
these three.
yeah, yeah.
This
These three, yeah. These three are calculated independently, sir, because one, but we always focus on the main one, the Engine FS. The other two we have given for reference, and later on we plan at some point. We have quite a few development items. As soon as we go through them,
mm,
we plan on exposing this model so people can create their own models, right? Instead of following just the one we've given. But the first one, the 8.08 Engine Fund Score, that is the one that is used everywhere. Um, yeah.
and my another thing was, good to see you have, you have inserted that up market and down market thing slided there in the funds.
Yes.
In the funds.
Yes, sir. Yes, sir. Of course.
Section.
Yeah.
Yeah, so that was not there earlier.
Yeah. Sir, we have added. We have a constant development list, sir, which is usually which always comes from feedback. So as people ask for things, we continuously add them to our development list and keep taking it out on our releases. So, and we also document our releases on our main website, on the public website. So you can also see all the new things that have been added over there as well.
Two, three
Yes,
suggestions
sir.
were, there is no quartile ranking. The
Yes, sir.
quartile in Q2,
Yeah.
Q4.
So by quartile ranking, you mean like top quartile, bottom
Yeah,
quartile, things like yeah.
the fund has given this return, keep remaining in Q2 or Q3 or Q4 or Q1.
So sir, when you say Q3, Q4, you mean like dates, right? Like Jan, Feb, March, or do you mean the quartile in the
No. Top, you have a square. You have a
yeah.
square. It is cut into four parts.
Oh, yes, sir. So I'll tell you, sir. So some users have asked for this. The only issue there is, sir, the number, let's say we want to do quartile ranking of funds in in a particular SEBI category. um, it's almost always really impossible to cut properly into four, because it's not like there will always be 12 funds or 16 funds or 20 funds, or clearly divisible by four. And what happens then is either you have to throw away the bottom funds, or you have to have quartiles that are not equally sized.
I,
Um, so because I know quartile rankings, etc., are used quite widely in the industry around the world. But one thing we've always had an issue with is that it causes unnecessary approximation. So, which is why, when we created the fund score, it was more exact and less approximate. Because if you look at a number, this is out of 10, right?
right.
So, and if you can have 50 funds in a category, you can have 13 funds in a category, or 23 funds, doesn't matter. Your
Mm.
position is clearly indicated between 0 and 10 by your score. It's almost like a score out of an exam,
Agreed.
or out of 100, right? So
Agreed.
here you get far more precision in this way. Because, for example, one big issue with quartiles is, let's say you have 12 funds in a category,
Right.
and then some fund is in the top quartile, but right at the bottom of the top quartile,
Yes.
what if one fund goes away, gets
Mm.
shut down, or another one is that fund will move in the quartile just because of the introduction of another fund or the deduction of another fund, and through no fault of its own, not because of its performance, but because there's more or less funds in the in the sector now.
Right.
So the thing is, I mean, this will apply to fund scores as well, to an extent. But the point is, it's much far more pronounced, because it may look to you that this fund is maybe doing badly because it's moved from Q1 to Q2, but it
Right.
hasn't really done anything bad.
Right.
And so it's just one of the issues that happened. But the method of using quartiles is just inexact, and that's the reason we haven't really gone into it, especially when there are much more precise ways of doing this.
Agreed,
Yes.
Arunabh. See, this is one keg in the wheel,
Yes,
in
sir.
research which I do.
Yes,
So
sir.
it only tells me whether the student is always in the top 10 rank,
That's right. That's right. Yes, sir.
student is always in the 10 and 20 rank, whether the
Yes,
student is
sir.
in the 20-30 rank, or whether the student is always in 30-40 rank.
Yes, sir. Yes, sir.
Right?
Yes, that's
Oh,
right.
if not, if he's moving up and down, so
Hmm.
how volatile is he, and how inconsistent or consistent he is in Q1, Q2, Q3, Q4?
Yes, yes, sir. So
By
this,
rank and
yeah,
by consistency in number of years, say 10 years,
co-
15 years, or 5 years. So that
correct.
that gives me I mainly look at the consistency, and that is
Yes, sir.
one part of the total research.
Correct. So, sir, what you're looking for here, you will actually get the exact same answer to what you just said. Because if you look at this chart, there's on the screen share, this
Mm.
blue line is quite literally saying that, but with much more precision. Because if you have only four funds in a particular categories, in a
Mm.
category, those scores will reflect that.
Right.
And someone, if it's doing badly and becomes third or fourth in its class, basically, its fund score will drop significantly because of that.
Right.
So when you look at the history over the last 12 months of this particular fund, what is this? This is HDFC Balanced Advantage Fund 8.08. So it's doing quite well. And as you can see in its history, it has been doing quite well. It's
Right.
always been over about seven,
Right.
in terms of its position within its category. So
Right.
that's a good indicator that it has never really done badly, at least in the last 12 months, we can see here.
Right.
And on top of that, you can see that in terms of risk score as well as return. And you can see again, this also tells you that the reason is up because it has a high return. But in terms of volatility, it's not doing that well because the risk score is quite low,
Right.
so it's quite volatile, right?
Right. So,
So the thing
so
is,
here
yeah.
risk score
Yes, sir.
high means better or low means better.
No, no, sir. Risk score 10 is good, 0 is bad. So
Okay.
a low volatile fund will get a high risk score, risk score.
That is what I suggested,
Yeah.
to term it as volatility protection risk score.
Yes.
Protection.
Okay. Yes, I can understand. It can be confusing otherwise. It might
Yeah,
be
the
like,
risk
yeah.
for as
Yeah.
such, risk means generally what the belief would be, lower the
It
better.
should be low. Yeah. Projekta, let's write this down. We should provide some explanation or
Yes,
change
sir.
how it says. Yeah.
Yes.
And put a word as consistency in your
Consistency, actually, that's much better. Yeah.
return, say risk protection consistency score and return consistency score.
That's right. Yeah, fair enough. Makes sense.
And one more thing I saw in the SIP, in the compare
Mm-hmm.
section, in the SIP, there is no category.
Category for what, sir?
Category return. In the monthly SIP, if you see,
Yeah.
for any fund, you also have to take the category also inside.
Right. Okay. Oh, I see. When you add a
Yes. So
category
basically, when you
average.
take a category average, it does
No,
not
it
come up
doesn't come
as a
here.
row item in monthly
Yeah, it
SIP.
Oh.
doesn't come.
Yeah. We can definitely do that. Yeah.
It comes
Yeah.
in the
Let's yeah.
rolling returns. It comes in the lump sum. See, if you look
Yes,
at
sir.
it is there. It captures.
Yeah.
It
Yeah,
captures.
there is no reason why we can't do monthly SIP for the historical category average also. That's fine. Yeah. Yeah. Let's add that. We can.
It will not be there.
Understand. Yeah, we will do that, Projector. Let's write this down.
And
Yes.
can you head down to drawdowns, please?
Sure.
Drawdowns, you see,
Hmm.
if I have to pick up, see, basically when the category is mentioned, it is much easier for me to select which one is better.
Yeah.
But again, I have to flip flop 3 parameters to check which one is better.
That is true, sir. You're right about this. And
So
to be
if
honest, as of now, I can't think of how to make this easier. If you
no, no,
have any
no.
suggestions,
This is
we're happy
this
to.
is
Yes.
appealing. This is appealing and attractive and very,
Yeah.
very figurative and very good. But
Yeah.
only in, there is no Excel given here. Excel download.
Okay. Yeah. No. We can definitely do that. There's
Excel
another thing
download
for us to
for
do. Yeah.
researchers, Excel is a boon,
Absolutely. Yeah. Absolutely. No, we'll definitely put an Excel download here, sir. That
right?
we can do
And
quite quickly.
if these things are tabulated, if these things are tabulated there, I
Hmm.
can straight away look at the recovery period, the recovery this thing,
Yes. Fair enough.
right?
Yep. We can add that.
Right. Similarly, risk versus return.
Yeah. There is. Is there no Excel download? Okay.
There is no
So
Excel. There is no Excel.
right. Okay. We can add that as well.
So if you look at it, we put the show data labels on the chart.
Yeah.
So now every now and then I have to click, I have to note it down. Then
Hmm.
I have to tabulate in the Excel sheet. Then I have
Yeah.
to divide or minus to come at a figure which has functioned or performed well by
Yeah.
vis-a-vis category.
So here we'll definitely put an Excel download anyway here.
Yes.
But since these numbers are basically return and
Yes.
volatility,
Yeah.
they will still be available in the main list. Only thing is there is no end date option here. So
Yes.
if you pick a particular start date, you'll still be able to get the standard deviation column is there, and there is a return column also.
No,
So you'll be
this
able to.
main list is to filter.
Yes.
When I filter and finally I am moving to the top 10 or top 5, that
Yeah.
time drawdown and risk return comes into picture.
Understand. Yes.
So,
Fair
so,
enough.
in FlexiCap, there are 39 funds. Now, 39
Yes.
funds, it's very, 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 tedious to figure out what it is without the Excel table. Just for
Understand.
Sir, for example, just put FlexiCap. You will know.
Yeah.
Thing.
Yeah. There's too much. Yeah. No. So, Prajakta, let's write it down. So for risk return also, the data on the chart, we'll put it into Excel and give
Yes.
them a download option.
Done.
Even in the drawdown.
And drawdown. Yeah. Both that we've
Both
already got.
noted. Both noted
So
down.
when the figures are there, it is much easier for us to calculate or put formulas and then get to know.
Fair enough, sir. Fair enough.
right? And
Yes, sir. Absolutely.
one more suggestion there in the
Yes,
drawdowns,
sir. Yes, sir.
you can look at ulcer index.
Okay, we will have a look at it. Yes. We haven't checked that
ULCER,
one. Yeah,
ULCER
ulcer. Okay, fair enough. We'll
index,
yeah.
ulcer index, better version, better than that is Martin's ratio.
Okay, fine. Martin's ratio. Yeah, I've not used these before, but I will check. I'll definitely check.
They specifically, signify the recovery and the down capture ratio and the performance during that time and all. So if you
Right,
Google,
right.
you would be immediately able to understand it.
Yes, the formula seems. I've just checked on Google. It's the formula seems pretty straightforward. It's price minus the maximum price.
Yes.
So
Ulcer
how
index
far it
will,
is away from the peak, basically, right? That's what it
so
is.
ulcer
Yeah.
index, instead of all those three figures which you are giving in the drawdown,
Yeah.
one additional measure, one additional value which you put as ulcer index or J. Martin's ratio, the man who coined this ratio,
Yeah.
if that is put here somewhere in the front, that one single measurement, that one single figure will tell me how much it has dipped, how much it has been in the valley, and how fast it has come up. So higher
Fair
the
enough.
Martin's ratio, higher the ulcer index, better the drawdown recovery.
Understand. Yes, of course. That's this distance from the maximum price.
Yeah.
Yeah, that makes sense. Yeah, yeah, we can do this. So we will definitely add this. We will start by adding it into this section as well as the individual drawdown section. We'll add these two things as well. That'll be very useful.
One single matrix, one single
Yeah,
matrix.
yeah, yeah.
J. Martin is
That's
ulcer
very
index
very useful, sir.
common. Ulcer index is common, whereas Martin's ratio is the better version of that.
Fair enough. No,
Sure, so we have
we will
noted
look
that
at
down.
both. Yeah.
Yeah. So these are some certain things which were there in my mind. I've been
Thank you,
using
sir. Well,
I've been using your this thing for last a year, I guess, but
yes,
never
sir. Thank you.
forgot to. I always used to labor on all these pages where the Excel sheet was not there. I had to labor.
Understand. So no, we will add this this end of this month. We'll have a small release, so we will add the Excel downloads will be there very soon.
One more thing, there
Yes, sir.
is one in the compare section. The skewness is coming at one place. Skewness comes at one place.
So that is in the distribution analysis.
Yes, this skewness
Yes, sir.
nobody will understand. So here the skewness we have to see
Mm-hmm.
the positive side is better rather than the negative side.
Definitely, sir. It's just showing which way it's tilting, basically.
Yes, yes.
Yeah, yeah.
So there is skewness, there is kurtosis.
Of course, sir. So
Key,
kurtosis, and we can show these numbers, but
SIS.
it yeah, it gets statistical. So
Yes, yes.
mostly our users are not
Familiar and not
going into
required.
that detail, right?
Yeah, familiar
So
and not required.
yeah,
But as a reputed and quality platform provider, I
yes,
think
sir.
Morningstar has all these things.
Of course, sir. Yes, sir.
Morningstar has all these things.
Yes, sir.
So I saw this skewness. It doesn't
Mm.
see in the broader term and in the regular day-to-day term, this
Mhm.
the skewness and all, we may not look at it.
Yes,
But
sir.
as you were just explained a while ago, all these
Mhm.
smaller deviations and corrections will smoothen out into a very smooth flow of beautiful
That is definitely true, sir. That is
so
definitely
these
true.
are the smaller parts.
Yes, sir. Absolutely.
Yeah.
Perfect. So thank you very much for your suggestions. We'll work on those and have them out very soon.
Yeah. Thanks a lot. Do inform me as well.
We will do, sir. We will do, sir.
Especially the Excel sheets and the categories and the measurements and the numbers.
Of course, we will definitely we'll definitely let you know, sir.
Yeah.
Perfect. Thank you.
That is basically urgent.
Yeah, understand, sir. Understand.
Yeah. Those are very key parameters.
Yes, sir. We'll get them done.
Even one suggestion, you have given up market and down market ratio individually.
Yes, sir.
You can give additional number there as capture ratio, which is up divided by the down,
Right.
which will be
Yeah.
always one or greater than one.
Yeah.
But then somebody who has to look into the up market and the down market very cleverly, very properly, then only they will know which one to select.
Yeah, fair enough. We can put that, sir,
It
because
is just
obviously both are
a
calculated.
mathematical or algebraical calculation, up divided by the down.
Understand? Yes, sir. We can put that on there.
Yeah, up market ratio divided by the down market ratio will
Yeah,
give a rating of one and above, which is less than one and which is less than one, meaning the down market is higher than the up market.
of course. Yep. We'll definitely add that.
Please just keep it in mind and note it down, and as and when, sooner the better.
Yes, sir. Yes, sir. Definitely. We will release that.
Yeah, yeah. Thank you. Thank you. Thanks a
Thank you,
lot
sir.
for hearing me
No
out.
problem. Thank you, sir. Any other questions? Please let us know. Okay, if there's nothing else, Prajakta, we can close for today.
Yes, sir. So thank you so much for joining in. Do stay tuned. We will come up with a new and interesting topic in the next week. Same Friday, 4 p.m. In the meanwhile, you can definitely check our previous webinar recordings on our YouTube channel. The link for which is right there into the login. You simply click on this YouTube icon. You'll be taken to the NGEN Markets YouTube channel. And then there's a dedicated playlist for webinars. You simply click on webinars and 112 plus videos already uploaded. So you can definitely check these out. So thank you so much again, and have a great weekend ahead.
Thank you. Thanks a lot. Same to you.